Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields continue to decline. We saw another decline today on Wednesday, yields nearing a very key level, 275. We've gone from roughly 3% down to 275 since the Fed last met just a few weeks ago in June. And the market right now is really acting very confused. We've seen a lot of guessing of where the next rate hike or how the next rate hike or how the next piece of economic data is going to affect the Treasury market. And ultimately, it's all been pushing yields lower and prices higher. And that has kind of been the new trend, something we didn't expect after hearing Chairman Powell speak after the Fed meeting and then again a week later in Portugal. So a couple of things that are just really kind of confusing the market right now is you're seeing yields go down and you're seeing prices go up amidst a hawkish Fed and positive data. And if you can, as expected, market volatility is actually slightly higher, not much, but we are seeing a slight uptick in Treasury market volatility, which it should, because you're going against expectations. It's sort of what we call the trade of pain. We've been calling it that since the Fed meeting. As yields go lower, it seems to be attracted that way because it is the trade of pain. Most leverage funds remain net short, and they are still holding on to those shorts, looking for that big reversal, which in common sense wise would come. But when you're looking at things through a different glass and all the uncertainty, we're looking around the globe and we're looking at here domestically, and you have trade wars and you have equity markets all over the map, it does seem to think that the flight to quality bit of yesteryear has come back a little bit, just isn't coming back the way we expected it to. It doesn't come back in one day or in one big move. It's slow and steady. And so volatility is seeing a bit of an uptick, but nothing that would put into fear gauge, but certainly higher than would be expected. But as we're moving against the trend, I guess volatility should be higher. And lastly, let's look at that yield curve. Where has it gone? Well, once the Fed came in, we saw it start to flatten initially after the Fed meeting in June. We talked about maybe that being a shift in short end rates more aggressively than the back end, but ultimately it has really, I think, very little to do with that, more to do with the uncertainty in the economy and with what's happening with the administration and their negotiations with China and things that are happening overseas in Europe. And if you look at the Middle East, there's a lot of balls up in the air. And I think right now that the flatter yield curve is just more of a suggestion of there's not a whole lot of confidence that there's a certain ideal or certain trend that's going to take place in the next, call it 6 months. And I think that takes us all the way out to the latter half of this year. And the yield curve right now in the 2s10s is down below 32. It's nearing a 30 level. We're back, we can take it back to decade low levels, but it just doesn't show any sign of reversing. And that's the key. We're not seeing any modest upticks that are followed by modest downticks. It's just been a straight shoot. So as we continue to look at the Treasury yield curve, we can look at that for a sign of just greater macro sort of momentum and emotion in the market. And the equity markets, they really got beat up bad, but ultimately I think the yield curve's been telling you all along there isn't a whole lot of uncertainty and confidence being priced into the bond market that tells you to own anything else down the road, at least further than the next few days, because certainly the next several months are certainly very unclear and gray given the look at the yield curve. So yields continue to trend lower. Volatility is higher. The yield curve is flatter. We do have some data coming out throughout the rest of the week. And don't forget next week's job numbers and June FOMC minutes. You don't want to miss that. This is Todd Colvin coming to you from the floor of the CME Group.